made an IPO to raise roughly more than 650 odd crores. This is in the price band of around 285 to 300 rupees per share. But to know more about the financials, business profile, valuations, and of course the peer group comparison, we're being joined by Yatharth Tyagi, the whole-time director of the company. Afternoon there. I'm going to start off first with basics first. Part of the fundraising also includes the IPO also includes FPO. Want to understand how are you looking at this? That's my first question. And I'd also want to, beg your pardon, it also includes offer for sale. That's one. Why offer for sale right now? And how do you intend to utilize the proceeds?
Hi, thanks for having me over. So the total IPO size, was 807 crores, and around 2 weeks back we did the pre-IPO. So the issue size was reduced there. So around 410 crores is roughly the primary IPO size that we have, and the rest is the OFS. So the primary, the bifurcation, if I can tell you, is 245 crores will be utilized to repay the existing bank debt that the company has, and post listing the company would be completely debt free, so we'll repay all the bank's borrowing there. The remaining 133 crores will be utilized to buy medical equipments for these 4 existing hospitals. So we're looking to buy oncology machines, robots, surgical robots, as well as other latest equipments there. Remaining around 65 crores is reserved for unidentified acquisition. So we'll be looking to acquire new hospitals going forward, and that's what 65 crores there is. And the remaining is the GC, general corp expense, which should be mostly be utilized for acquisition itself going forward. So that's the overall breakup of the primary that we're trying to do. As far as the OFS is concerned, 3 people from the promoter group are selling their stake. So Vimla Tyagi, Premnayan Tyagi, and Meena Tyagi. However, the promoters, Dr. Ajay and Dr. Kapil, they're not selling in the OFS.
So that's precisely why I wanted to know why an OFS at this point of time. It's also to capture the momentum of the markets. Why more dilution? I would just wanted to understand that, because much of the IPOs that are hitting the capital markets at this point of time have a component of OFS.
So well, for us, it was to make up the size for the IPO. So we had to offload to reach that size because of the valuation that was kept. So yes, we did have the option to do it after 2 to 3 years to make our stake, around 75% for the public. But we thought it's better to do that right now. So to make up the significant size to meet up the SEBI rule, the OFS was included. Also, second was done to make it also a significant overall size, so we are able to attract big and leading investors in terms of anchor, and that's what we were able to do yesterday when the anchor list was out. Some of the marquee investors, both globally and international, were able to participate, and got a significant chunk from the IPO because of the IPO size. So to meet both these factors, the OFS component was added to the primary as well.
Sure. I wanted to understand a little bit more about the utilization of funds. 95 crore of the fresh proceeds are earmarked for Jhansi Orcha Hospital, which was non-operational since FY20 until FY22 and incurred losses in the financial year gone by. When do you expect turnaround here, and what top-line contribution can come in from this hospital in this financial year?
So, this is the hospital the company acquired and started this in fiscal 23. So last year was the first year operation of this year. Before that, it was non-operational for 2 years when it was being run by the previous promoters. So when we acquired the hospital, we started it, and it was just the first year. So yes, the first year is usually, when we see EBITDA negative and profits, but usually we have a trend similar to the hospitals that we have in Delhi NCR, that by second and third year is when, we're able to turn them around and make them EBITDA positive. So that's the plan with that. And I think as far as the top line contribution is concerned, we feel because, as you said, 90 crores will be utilized into the capex into this hospital. So, major portion of that is buying oncology machines. That includes Liniac, PET scan, gamma X-ray, which compromises nuclear medicine. So around, an oncology setup is 35 to 40 crores. So that is what we're going to start in Jhansi Orcha. That will be done next year. And once we do that, because this is a huge territory, it's a region in Bundelkhand where Jhansi, Orcha, nearby villages in Madhya Pradesh, they comprise this Bundelkhand area. So this has a huge catchment, a lot of population there. And there's not a big super specialty hospital of this scale in this territory, although patients were coming to Delhi before this. So that was our thought process when we acquired this hospital, to stop the flow of these patients to Delhi for all these super specialty services. And once those services are set up there, we expect very good top line contribution there.
All right, and you said that was to the tune of how many crore when it comes to the top line, and what percent exactly of your revenue can be targeted in this financial year, please?
So I think it would not be right to name an exact number on the targeted revenue, but as far as the occupancy is concerned, we are looking to do an occupancy of around 60 to 65% there in the following years. And with that, yes, even though the overall ARPOB, average revenue per occupied bed, is less there compared to the markets of Delhi NCR, we do expect this contribution to be significant.
Okay. Let's talk about financials in that case. What explains over threefold jump in the profit and over twofold jump in the revenue from FY21 to 23, and what run rate can be expected in this financial year?
So, over the course of, last 2 years, 50% from latest 420 crores to around 402 crores to around 520 crores in the latest fiscal year. This jump has been significantly contributed by 2-3 factors. First is the fact that we, during COVID, we were sort of one of the largest private players in Delhi NCR and nearby geographies is concerned. So, patients all over the UP, Haryana, Madhya Pradesh, as well as Uttarakhand came to our hospitals. So once COVID ended, so those geographies, our catchment areas grow. It was really expanded. Pre-COVID, we were catering to patients who were mostly in Noida, Delhi, and local villages. But post-COVID is where, as during COVID, patients came from all across these regions. So post-COVID also, these patients continued with us because of the loyalty on the brand, the brand equity we developed. And fiscal 23, I can restate that doesn't have any COVID revenue. So this is all non-COVID patients. So post-COVID, that's the growth we had in terms of brand presence, and in the geographies we operated, that was a significant growth. Second reason, for the growth in the revenue, in the last couple of years has been due to the change in the case mix. So, now we are offering certain treatments that we were not offering a couple of years back. For example, we recently started kidney transplant, bone marrow transplant, and we're moving towards a hospital chain which is focusing much more on super specialties like cardiology, neurosurgery. So due to these high-end ticket size is a big reason for these contribution in couple of last year.
Sure, Mr. Tyagi, I'd want to understand number, if you can put a number to the run rate that we can look at for the financial year 24, just to understand if we can expect the momentum to continue, as compared to what we've seen in the past, or you expect that to slow down a little bit?
No, I think as far as top line is concerned, we expect a similar growth to what we have shown over the course of last 2 years. So we can expect a similar growth for next 2 years. As well as, even our EBITDA margins are concerned, I do expect even EBITDA margins to grow. So right now we're doing roughly around 25 percentage of EBITDA margins. I feel that in the next couple of years, these EBITDA margins are bound to grow even beyond 2-3% up and down, up, because the growth is coming up from our organic facilities. Our existing hospitals are bound to grow much more in occupancies. So because, most of the infrastructure and doctors are kept in these hospitals, so we do expect EBITDA margins to grow up also in the couple of years to come.
So you say a 2 to 3% increment in margins in this financial year itself that you're expecting?
In terms of EBITDA, somewhere around that.
Okay, so since you have given us a margin guidance, which is 2 to 3% higher, why don't you even talk about the top line in that case? What kind of growth can be expected in this financial year?
So, as far as margins are concerned, I was mentioning around that times, and over the course of, 2 to 3 years is what we are looking for those margins. And roughly, the revenue should grow similar to what we have shown in the past couple of years. I think similar margins could be expected for years to come.
All right, Mr. Tyagi, let's talk about your occupancy rate. As compared to that of peers like Apollo Hospital, Fortis Healthcare, Narayan Hrudayalaya, beg your pardon, and Max Healthcare. For Yatharth, it stands at around 45.33%. That's the bed occupancy rate, as compared to the counterparts like, you have something in the range of 50 to 64 odd percent. So what explains this, and how do you intend to improve those?
So, overall occupancy, does look like 45%, but it not be a fair representation because two of our hospitals are recent additions. And, if you exclude those, would give a fair representation. But let's talk about hospital-wise occupancy to understand that better. In Noida Hospital, we did an occupancy of 87% last year, which is very high compared to the industry peers there. Even in a Greater Noida Hospital, which is again one of our mature hospitals, we are doing an occupancy around 62% there. As far as our other two hospitals are concerned, that is Noida Extension, which started in 2019. And for first 2 years, this hospital was mostly COVID. So post-COVID is when the non-COVID operations started in this hospital, and the occupancy was around roughly 30% last year, sharply increasing. If you look at Technical Hospital, it's a year and a half old in terms of non-COVID operations are concerned. And Jhansi, because it's first year of operations post-acquisition, that's where the occupancy was low there. So we expect going forward the similar levels of occupancy that we are doing in our matured and older hospitals to also come from a newer hospitals.
So what can be the rate that can be expected in this financial year? Can it be upwards of 50-55%?
Should be more than that. Yes, roughly around that. But let's see, how far that occupancy can ramp up there.
And this is in this financial year that you're talking, FY24?
For a few years ahead.
When you say few years ahead, it could be FY20?
Yeah, 2 to 3 years.
Okay, so you expect it to be a northward figure of around 60 odd % by FY26 in that case?
We cannot say an assertive on that, but we can see how that goes ahead.
Okay, since the industry that you function is pretty competitive in nature, what's your USP here?
See, I think we are present in geographies which are multiplying in populations year on year. If you look at the cities of Noida, Greater Noida, and the nearby geographies the patients come from, these cities have really developed over the course of last few years, and we were early movers in these cities. When our first hospital started in Greater Noida, that time Greater Noida was an upcoming city, so we had a really early mover advantage in the geographies that we operate in. Even in for that matter, Jhansi Orchha, we are the biggest hospital in that region. Even in the terms of Delhi NCR, we are one of the largest players. In terms of Noida, Great Noida, our hospitals are among the top 10 largest private hospitals. So the economies of scale, as far as the size is concerned, has really benefited us, and it has given us a competitive advantage in the cities we operate. So in Noida Extension, we are the biggest private hospital there. In Greater Noida as well. So that has helped us compete and attract really top quality doctors, attract top management professionals. And going forward, we also want to continue on that front. Also, another point is our infrastructure, because two of our big hospitals, we started in 2018 and 19. Our infrastructure right now is one of the best in Delhi NCR at a price which is 20% cheaper from our competitors. So that has really helped us grow, driven the growth and sort of our USP for the growth.
All right, let's talk about the segmental breakup in that case in terms of the revenue from medicines, which have come down from 56% in FY21 to around 31% in this financial year. A, what explains that, and what is the operating margin difference between the medicines and other specialty? Are you focusing less on medicines now? And if that's the case, why the strategy?
So, you have to differentiate that the medicine that you see there, these are not consumables or pharma drugs that we perceive it to be. This is Department of Internal Medicine, and that comprises of treatments like cough, cold, fever, general dengue. And this is a department, if you can understand better, which has physicians like post MD internal medicine doctors. So that is what exactly this 30% contribution is. And the reason why this department contribution has come down over the course of last 2 years is because we're moving and transitioning to a super specialty treatments like cardiology, neurosurgery. So internal medicine is a basic specialty that a lot of hospitals have, but now we're transitioning and increasing our shares of super specialties. And because of this transition, it is actually helping to increase our RPOP. Because average revenue per occupied bed is usually lesser in the Department of Internal Medicine compared to super specialty departments like cardiology, neurosurgery, and others. So this is why this shift is there, and I think going forward also we feel that our share of super specialty departments will increase, and this is actually helping us to deliver better numbers as far as margins and average revenue per occupied bed is concerned.
And how about the margin difference between the two, that is the super specialty and the medicines? Could you put in a number in perspective for us?
So I think we usually don't calculate EBITDA margins or profitability department wise. We do it, in terms of different treatments we offer. So, let's say cardiology is considered to be one of the higher profit margins compared to, let's say orthopedics or gynae. So, that has been a focus going forward. And even in those departments, we are starting the most profit and EBITDA giving departments like transplant programs. So an average kidney transplant costs around $10,000 US. An average bone marrow transplant costs around $20,000 US. So definitely margins tend to be higher in these departments. And oncology is a big booster also to both EBITDA margins, both RPOP. And this is what we are going to start from this year itself.
All right. And medicines, the margins from medicines is at the lower pile of the chunk?
So again, medicine, if I restated that is Department of Internal Medicine, yes. The basic specialties like, as it comprises of, cough, cold, fever patients. And these are the patients, usually they don't stay that longer also in the hospital. So usually margins are lesser from the Department of Internal Medicines, and margins are much more higher from super specialty departments.
Sure. Let's talk about the government scheme revenue mix. CGHS is right now 37%, which is higher as compared to many of the listed counterparts, which is usually in the range of around 10 to 20% on an average, in terms of percent of the revenue. Is that causing your average revenue per operating bed to be lower as compared to the peers? And could that be also a concern for ARPOB growth going forward?
So, it does the 37% government business. It just doesn't include CGHS. It also includes other schemes like ECHS, ESI. So these three government schemes are what, this represents. And yes, the contribution is sort of higher than our peers, but we are evenly poised as far as payer mix is concerned. So 1/3 roughly is, this government scheme, 1/3 is cash and self-payers, and 1/3 is health insurances. Now, the government business that you just mentioned is, it's higher compared to other peers, because you have to understand a couple of points here that, we are present in geographies which have a lot of patients who, own these CGHS, ECHS, and ESI schemes. So for example, Greater Noida has one of the Asia's largest society of ECHS card holder. So, and CGHS as well, a lot of bureaucrats and government officials. So our, these represents the patients that we're serving in our community, often, high demanding patients. Going forward, I feel that, yes, the increase of health insurance and cash patients will increase, as the healthcare insurance penetration grows on year in India. And it wouldn't be right to say the RPOP is less because of the high share of government patient, because our RPOP is less as we have, been not offering those high-end super specialty treatments, as I just mentioned, because earlier the majority of the contribution of revenue was coming from Department of Internal Medicine. But going forward, as a contribution from super specialty department increases, that's where the RPOP will rise from. And I'll give you an example of one of our hospitals, Nod Extension, one of the biggest hospitals we have in the region of 450 bedded. That hospital already has an RPOP of, around 30,000 last year. And that RPOP is increasing this year as well. This is the hospital, which has more share of super specialty treatments and less share of, specialty treatments. And that is what will help us to achieve higher RPOP going forward also.
Got your point. Let's talk about medical tourism in India. What percent of your revenue comes from the international patients, and how do we expect the mix to evolve going forward?
So, right now the mix for international patients was less, as we were not offering oncology, we were not offering transplants, and these are the major contributions to international revenue. This year itself, when we started the transplant program, and this year itself, we started oncology, and we're getting the radiation oncology machines. They're already on the way and should arrive, and the transaction should start very soon. That's where we expect this international patient contribution to grow fast. Going further, also you have to understand the fact that Greater Noida is coming up with Asia's largest international airport, the Jewar Noida International Airport. That airport is just 20 to 25 minutes car drive from our Greater Noida Hospital. So, we feel that going forward in the couple of years, and that airport is supposed to start very soon next year. So going forward, I think that will help us to to build international medical tourism, and we've already taken steps. So the Greater Noida Hospital will already expanding. We have got the adjacent land parcel, attached to the building of the hospital. We acquired that land parcel, and soon we'll be starting construction of increasing the bed capacity there, and that will be done on the likes of international facilities to attract those medical tourism patients.
What's the mix right now, you said? If you could put a number?
The mix is not significant. It would be lesser than 5%.
You expect that to grow over, say, a 10% by what year?
It should take 2 to 3 years. Especially with the airport coming up, it should grow much further than that.
Let's talk about your debt to equity ratio, which seems to be higher as compared to the other peers. 1.44 times is the number right now as compared to 0.6 seen by your other peers. Shouldn't that bother investors? I understand that the company intends to be debt free with the fundraising. Have I got that correct?
Yeah, so we'll be completely repaying all that debt post listing. So that's the plan, and I don't think there's any reason for that for the investors for that cautious. Also, you have to understand why this debt was there so far. 100% of the equity of the company was held by promoter and promoter group. So there was no private equity investment, and this is sort of the so bank was the only partners for the company, and that's why the debt was there. Now going forward, post listing, the company will be completely repaying all that debt.
Mr. Tyagi, got your point. Thank you so much for taking out the time and speaking to us.
Thank you. Thank you.
All right, that was the man.